how would you design a policy from base to PUA?
You know, when you design policies, you can design them different ways, but there's pros and cons to that.
Let's take policy 1 and policy 2. Policy 1 is optimized 50-50, and policy 2 is like a 80-20. You could say that over a long period of time, the 50-50 policy might have greater dividends, but in 30, 40, 50 years, the policy 2 with 80-20 might have smaller dividends, but a lot more.
I will just tell you my policies, almost all of them are base 40%, PUA 60%.
No term riders?
I do not have a term rider on one. Now, is a term rider bad?
You learned about infinite banking. You paid off your debt in 3 years. Some people are saying, well, you just transferred your debt. How would you answer that?
What most people do, they'll take the debts from lowest debt to highest debt. It doesn't matter what the interest rate is. Take it from the lowest amount to the highest amount. Well, then people say, okay, well, you got it all paid off, but you still owe the policy loan. Do you have to pay the policy loan back on a certain timetable? No, because it's your debt. You control when you want to pay it, if you want to pay it.
Early on, I could care less about the death benefit, and now like the death benefit is what I care most about when it comes to planning.
Well, my kids really care about it.
Yeah. Human life value versus starting a small whole life policy. Early Caleb would have started the whole life policy. Now Caleb would say, your mindset changes completely when you have $34 million of death benefit on your life. All right, Brent, our first episode that we did together in person was a smashing success. It had at the time of this recording, over 15,000 views.
Wow.
And lots of comments, a lot of people reacting to it, and a lot of people wanted to know part 2. And one of the things that we promised is to peel back the onion more about how you're using infinite banking with debt, how you're paying that off, and then just all the other things that you've learned since we sat down in person well over a year ago. So my first question that I have for you is, since we last recorded, has there been any change that you've had when it comes to infinite banking, whole life, how you set up whole life, and how you use whole life? Or has nothing changed and everything is the same as a year and a half ago?
Yeah, and I can't think of anything that's changed, and it's kind of the thing that you asked me, has anything changed? And I always say to people, I say, look, man, I've been doing the same presentation since I stepped on stage for the first time in March of 2012. I've been doing the exact same presentation, the same content, that show the same slides. I probably got to update some stuff because people, are not used to seeing a 1990 car in my example, because I've been doing it for so long. So the only thing that has changed maybe a little bit are the numbers, and that's just because of the scale and the dividend scales of policies and guarantees and things like that. But as far as the content and the process, it's, there hasn't been anything that's changed. I would say that, and again, this isn't really a change by me, but maybe others on our team that talk to a lot of our clients. We call them the mentors, the money mentors that are on our team. So anyway, back when I just first started teaching this stuff, I was very big in what Nelson Nash had in his book, Becoming Your Own Banker. Every policy that I designed had X amount of base premium, X amount of PUA, and I just call it the Nelson plan, the 40-60. If you go look at the equipment illustration examples in the Nelson Nash book, Becoming Your Own Banker. And then, as we kind of expanded and had other people and mentors come into our team, they tended to change the design of the policies a little bit more, right? Where they get a little less base and more PUA. And I don't want to call them 90-10s, because they're not. They are, but they're not. They just give you more cash value early on. And for example, if we have a client, and a lot of our clients are into the thing, investing into real estate, right? So they're really they want cash now. So if you tell them, hey, the thing we're going to do is start a policy, and in the first year you get 58%, 60% of cash value, even though it's all your money, they can't access it right away. They're like, oh, well, I want a little bit more, So, and again, Caleb, as you know, when you design policies, you can design them different ways, but there's pros and cons to that, right? So if I give a client a policy where he can access 92, 93, 94% of the cash value in the first 30 days, that's all good, but what does it do long term? for the policy. And what more of a cost does it come at? Because if you do a policy like that, you have to add term insurance on. Term insurance that you're never going to use unless you die early. And if the insurance company thought you were going to die early, they would never even issue you the policy. So your chances are you're not going to die during that term coverage that has to be on the policy. So those term riders, so I'm not a big fan of those. If I'm talking to clients, I'll tell them about them, and it's always their choice of what they want to do.
You're not a big fan of term riders, or not fan of like small bases?
Well, both.
Okay.
Actually, because there's a song out there by Megan Trainor all about that base, and I kind of refer to that sometimes when I talk to clients. I'm like, hey, look, down the road, you want some good base premium going on in that policy. Year 5, 10, 20, and on. You want to pay that base because that base, has a great growth, and it keeps you out of the mech limit. Like if you design a policy with a low base and a high PUA. Now you got the mech limit that you're fighting against, as well as having to add term insurance onto the policy. And if you really look at it over the long period of time, eventually you have to drop off that PUA. Well, when you get older, all right, that's when you want to even put more money into these things because of the growth. So you don't want to take your premium and just dial it back. You want to put more in there. But because of the mech limits, you sometimes can't do that. And you got to have the term rider on there. So
Brent, in your opinion, what is the way that if someone were to come to you and say, I will listen to everything that you say, we'll leave out the company at this point, but there's a lot of companies that we both work with. How would you design a policy from base to PUA? And for those of you that are watching this for the first time, and if this is your first time watching and you haven't seen my interview with Brent, we'll make sure to link our first interview where you share more of your story and all. So we'll have that down below. But base is back in the day, the whole life insurance policies were written with 100% base, and so that's where and you'd get almost no cash value in the first couple of years, but over time you would build cash value. A lot of the commission comes from the base contract, and that's essentially how insurance was built. And then, I don't know when the PUA rider, was invented, but the PUA rider and what you're saying is the term rider are both ways to use, essentially get more money into your policy. And Nelson talks about PUA riders, and I believe in his book he talks a lot about 40% going to base, 60% going into PUA. When I first got started, the people that I learned from kind of used Nelson's book as the Bible and just said, this is what you do. And then when you start poking around, you're like, well, why do we do this? And the answer was always, well, this is what Nelson said. And I don't personally like that answer. I'm like, okay, are we just gonna like I want to be able to challenge why something is, just like the same thing with my faith. I'm a Christian, but I want to know why I believe what I believe, not just taking what my parents told me. And so I think that's important. And I think that's the same importance from this conversation. So answer that. And then I would like to jam about PUA riders and term riders, because I have a different perspective, but you're not wrong. And I think that it will be interesting for us to have a convo around that.
Yeah, no, absolutely. And again, so the thing that we're doing with our conversation right now is the thing I try never to do with the client is really talk about the actual product itself, because it's all about the process and how you use the policy. And there's not a right way or wrong way to design the policy. It depends on where the client's at and exactly where their needs are and what they want. So I understand if you have a client that really, really has to have as much cash value right away out of the policy, then you got to design it a different way as to somebody that doesn't need all the cash value. Now, I will just tell you my policies, my personal policies, 29 or 30 policies now that I have, almost all of them are base 40%, PUA 60%. Now, if it's a child's policy, the policies I got on my kids when they're younger, or I have grandkids now, I'll put them at 60 or 70% base and lower PUA. So even less cash value I get early on because I see the value increase down the road. I'm not looking at the policy as 1, 2, 3 years or the first 5 years. I want to see what it looks like down the road, and I want to continue to put that base premium in the policy. So, and yes, that's the way that I learned it too from Nelson. Is I learned my stuff from the Nelson book and being around Nelson and being around him and listening to him, watching his seminars and things like that. And the mentors that I had previously in the game, their policies were designed like that as well. So I just right. So again, Caleb, on my own policies. I think the lowest I've ever done on my own policies is 40 base, 60 PUA, and sometimes a higher base, and just a lower PUA. Because I want to pay.
No term riders. No term riders, I would assume.
I do not have a term rider on one policy that I own. Not one. There's not one policy that has a term rider. Now, is a term rider bad? No, it's not, because you got to protect it from the MEC status, and that's usually why we do that, is because and actually there are some companies, because of the way their policy, their design, I'll call it the actuarial design, you almost have to put a term policy on everything in order for it to even work. You can't do just a straight 40-60 base PUA. Some companies you have to put a term rider on. So I've gotten more accustomed to that. I've gotten more okay with it, but I still, in my mind, and maybe it's just my mindset, I just feel like when I'm putting money towards term insurance, I'm throwing away the money. I talk all the time about, why would you want to have a term policy when only I think it's what, 2 or 2.5% of all term policies ever even pay out?
Yeah.
Because if the insurance company thought you were going to die during the term, they wouldn't sell you the policy anyway.
Yeah,
So,
could I challenge something, Brent? And
yeah.
this is so the reason that I've heard, as I'm asking questions about why people like higher bases, is the dividend is better on base versus PUA long term, and then the other thing is the ability to pay more longer. So it's like, if you have super heavy, you might limit your ability to overfund or continue to keep paying that premium. So I think those two things are valid. The point that I'll make, and I'll use the dividend conversation in the same place that I'll use the term conversation, is let's take policy 1 and policy 2. Policy 1 is optimized 50-50, and policy 2 is like a 80-20, okay? 80% going to PUA, 20% going to base. And you could say that over a long period of time, the 50-50 policy might have greater dividends, but in 30, 40, 50 years, the policy 2 with 80-20 might have smaller dividends but a lot more cash because of compounding. It got started with earlier cash. And so every time that I see it, it's like a lot of times the whole dividend convo is like, okay, what do you care more about, a higher dividend or more money? And it's like, I want more money, I want higher increases. And in fact, in that scenario, the 50-50 cash value never outgrows the 80-20 if you're putting in the same premiums over time. And so the same aspect is with when it comes to term rider. I'm with you on that whole deal, but the way that I see the term rider is the same scenario that I see with the 50-50 versus the 80-20. If the term rider is included into a plan that helps my cash value have better ongoing growth, and it gives me more flexibility, then I'm okay that I'm buying something that may or may not translate. I hope I don't ever have to use the term rider, but all I care about is the overall efficiency of my money. Like, how do we compare that? And in a lot of cases, and then I'll address the second thing, is a lot of people will say, well, you'll lose your ability to continue to fund. Well, we just did a whole infinite banking series on our channel that at the time that this is coming out is probably going to be in the middle of and we're looking at, I believe, 10 insurance companies, including all the ones that we work with. And it amazes me in how a lot of times we focus on the wrong thing, in my opinion. We're focusing on the base contract and some of the other things, and we're not actually looking at how PUA riders actually work. And we say that they're flexible, but not all insurance companies are crazy flexible when it comes to how you pay PUA riders and all. And so I think that's important to note from a standpoint of like if you stop 1 year or all, like every company has a little bit of a different interpretation of that. And everything that we've looked at is overfunding, even with term riders. It is important to see how long you can fund. And in a lot of our cases, we're seeing that you can still fund through age 100 if you want at those same levels. And so there's trade-offs if what you're saying is true, which I believe if you don't add a term rider, some of the times you can't maximize the premium going in because of the lacking term rider. I think it is valid if you don't include that term rider. I think it is valid to say you could put too much PUA, and then back in the OG designs, after 5 years, you would drop the PUA off and just have the base. And I think that there's a lot of different. You could heavily push back on that and say if you could fund your policy year 30, that's going to be super efficient. Why would you? You should want to try to maximize all those dollars going in. So I know I said a lot there, but that's how I view the term rider. Is I'm less emotional about the individual and just more I want to compare if I'm putting in $100,000 into contract 1 or contract 2, what gives me most flexibility, what gives me cash value. I care about the death benefit, I care about the long-term death benefit, I care about flexibility, and I care about the ability to continue to fund that 100,000. I think those are all the things that I would compare. And while term riders are that extra expense, I found that they still, in a lot of cases, overall help you be more efficient than not. But I would love to hear your thoughts on it because I know we're both in it day in and day out. Yeah. And this is why it's cool that we're having this conversation, because these are things that we need to talk more about. And very few people are actually willing to talk about this, Brent, because they feel like they don't want to discuss how the sausage is made because it's like proprietary. And it's like, well, it's not that proprietary, to be honest.
No, it's not. And yeah, so no, I get what you're saying, and I just comply with just a lot of it. And right. So the thing I find out sometimes though is when your PUA, right, if you have the low base and the high PUA, term rider, all of that on the policy, you can only put in the PUA for a certain amount of time, or your policy will mech, okay? But then I heard you just say the 100-year thing, which is awesome.
Well, but here's the deal. That can be the case at certain companies, and I will just say, if we are going back to the table, and in policy 1, I could have earlier cash value, but at age 12 or 15 of the policy, I could put in less. You have to factor that in, because every year that you have your policy gets more efficient. So I think to just give you props, you have to look at all scenarios. Every company is a little different. And long-term ability to fund and flexibility is really important to me. And so, you and I are super aligned as it relates to that.
Yeah. So anyway, that mech conversation comes in, and just as you said earlier, as you get older, as the policy gets more efficient, you want to continue to put in a higher amount. And if you have your PUA as a low amount, or as your base is a low amount, you're limited to what you can put in. I like, and again, as you said, all companies aren't flexible, but most companies, I know at least 3 or 4 of the ones that we work with are flexible with the PUA, meaning that it's kind of like the thing you do, you put in your PUA for the first 5 to 10 years, and then you may not want to put it in anymore. Well, you can, if just as long as you keep $10 a month, $100 a year, going into the PUA, it does keep it flexible. So if you have a lump sum of money or a windfall, you're able to dump it in. So I believe that you should always try to keep the PUA rider on there as long as you can to make it flexible. I mean, even if you're not putting the money in, at least do the $10 a month minimum, because I've got policies that were designed when I first started that I can't put any more PUA in. They weren't designed that way where I was able to. They just cut it off completely and didn't keep on my $100 a year, $10 a month, or whatever that number is. Now, I'm also, Caleb, I'm a fan of starting additional policies. You know, I'm a fan of it's kind of like if you have a bank, you know, and this is what this is, the infinite banking concept, becoming your own banker. So to me, a policy is like having my own bank, and it's my bank. I can use that money to do the stuff that I'm going to do in life, to pay my debts, my expenses, my investments, whatever it is. So if things are going the way they should go, as you get older, you should have more wealth than you do when you're younger, right? That's the way it's supposed to happen. You're not supposed to go backwards. I know some people do, but so the thing you want then is you want more money, or have more money to go into places. And where can you put it? Well, let's open up another bank. Like I can tell you, and I can probably speak the same for you. So the bank in Nashville, Tennessee, wherever you put your money in, whether it's Wells Fargo, U.S. Bank, Chase, or whatever, there's not one branch, there's multiple branches. So why can't you have multiple branches of your banking system? So we start one, and then we do another one, and then we do another one.
And Brent, do you start new policies after you've maximized you wouldn't start a new policy without maximizing all the premiums on your other ones, correct?
Yeah, generally that's the rule, but I'll give you an example. And this happens a lot to us, where a client will come in and say, "Hey, I want to start one of these things. I want to put in $1,000 a month." That's what they want to put in. So we designed the policy contract to where they're putting in $1,000 a month, X amount of base, X amount of PUA. It's $1,000 a month. Let's call it like 40, 60, 400 base, 600 PUA. So now what they do is they say, "Man, this is working really good. I didn't think it was going to work this good. I'd like to put in another $1,000 a month." Well, okay, Caleb, that's great, but you can't do it in that policy that we just started because it'll overfill it. So this cup right here holds 12 ounces of water. I can't get 15 ounces of water in this cup no matter how.
You have to start another policy. But that's my question. If they were only funding $500 a month and they wanted to start a new policy, you would say, "Listen, maximize your first one first, and then with the money you have left, then we can talk about the second policy," correct?
Exactly. I'm just not having them start it without maxing it at the first one. But again, let's use your example, $500 a month. If a person's putting in $500 a month and they come and say, "I want to put in $1,000," they usually can't do it in that same policy month after month without it mecking, So they have to start another one, or because you can't just put extra, right? You can't put extra water in the 10-ounce glass. You can't put 12 ounces of water in the 10-ounce glass. But yeah, you're absolutely right. And yeah, you should not start another policy too early. However, some people could start another policy earlier than they think they can, and again, this concept is a concept that makes you think outside of your comfort zone. You got to get a little uncomfortable sometimes, if you're going to continue to build this thing. And you may have a premium, you're like, "Well, I'm not sure that I can do that premium. I'm already doing $500 a month. I can commit to $500, but I think I could commit to $1,000. I know I can commit to $500, but I can commit to $1,000. Oh, okay. So if you think you can commit to $1,000 and we can't get that in the original policy, maybe now let's start a second policy for $500. So now you got your $500 and your $500, which is $1,000 going in, but now you can't do both of them. So what could you do if you had to? You could drop the PUA down on both of them. And just using my example of 40% base, you could do 200 and 200, which is still below your 500 limit. Now, I know that that may not be just the item of choice at your favorite smorgasbord, but it is an option. It gives you different options to be able to play in the game if you want to go a little bigger. But if it scares you to go bigger once you're in it, you can always come down. And there are sacrifices you might have to make for that, because if you're just paying the base premium of two policies, it doesn't give you as much cash value early on. So
I'll say this. The minimum and max is something that I think everyone can understand. And what we're talking about is, you have 30 some policies. You have a minimum annual, and I wonder if that minimum is pretty high, I would imagine at this point. Do you share your minimums of all your policies?
Yeah, I don't even know what it is exactly. I'd be guessing, but I'm putting in about $1 million a year in premium.
Okay.
Into policies.
But
now that's all not necessary, because I could drop PUA off.
Well, that's what I'm saying. So technically, if we're using just math, your minimum would be about $400,000 a year if you're putting in $1 million in. And so like for my wife and I, we have multiple policies, and we're looking at like, okay, what is the annual minimum and then the maximum, and then it's really important that like that number can be high. Like we want the maximum number to be super high, but I just want to make sure that, from an optionality standpoint, there is options, because while you have lots of options because you have cash value that you could take a loan against to pay the base if you wanted. That's not necessarily recommended. That we would never suggest someone get in on that to begin with, but you have option. Like there's a lot more options if the 1 year you didn't have the 400,000, your policies can self-fund if you have enough room in there, which there's a couple other things that I want to talk about from our last convo around the philosophy of using loans, and there's a couple questions that I want to reference. But anything that you want to add to that from a standpoint?
So again, I think it's very important that you just make sure that you can at least do the minimum. If everything falls out, you
Yes.
can at least do the minimum. And even though the base policy might be a $400 a month minimum, it's not really. All right. So anyway, it doesn't mean that has to come out of pocket if you got into a financial bind. Like you said, if you got into a financial bind, you're going to beg, borrow, and steal from wherever you have to in order to live and survive, right? So exactly like you said, we don't promote about you taking money from one policy to pay another policy. That's not something we promote, and the insurance companies don't like that either. But let's just use some common sense, man. If I own 10 pieces of real estate and I have one, which has happened to me in real life, get hit by a hurricane and it wipes out a $300,000 a year annual cash flow, where am I taking money from to fund that, to keep that thing going so I don't lose my shirt? I'm going to take it from the other properties that are coming in, right? It's just common sense. The insurance company doesn't have a police there at your door saying, now, when you take a loan, I want to make sure you're not using any of that loan money.
They just want to make sure that people don't get overextended.
Yes.
And like anything, insurance salespeople will be very creative to try to get people to be overextended.
Yeah.
Which, by the way, infinite banking has gotten rightfully so. Some people have overextended themselves.
Absolutely.
And that's what do you like? Because obviously Nelson in his book talks about like eventually income equaling premium. How do you navigate that? And like if someone were sitting across from you and wanting to like get into infinite banking but didn't necessarily know where to start, like what do you think is a good place to start from an income ratio? And then like where do you think is an ideal place to be long term? We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
Yeah. And again, I get asked this question a lot, and the answer that I give is I say start at the minimum. Start at the minimum, because if you're unsure about what you're even getting into, start at the lowest amount possible. And the way we'll talk to people is we'll ask them their age. How old are you? 30? Okay. $300 a month. 10 times your age is your monthly premium. That's basically about the minimum to have the policy work for banking, for you to be able to go into this without adding the term rider and just things like that, right? So that is kind of the general rule, 10 times your age on a monthly premium. Yes, it can be lower, but again, right, this is just a rough amount. So, but if you're really uncomfortable about it, if you're uncomfortable about starting but you want to start, then just do the absolute bare bones minimum that'll work. And if that number's still too high for you, then come back and talk to us later when you think that that's not going to be uncomfortable for you, okay? So that's the minimum. So start with that, and then if somebody says, well, how much should I do because I really want to do this? So here's what I say, and again, this isn't necessarily a right answer. I'll say, tell me what was your tax liability last year, Caleb? What was your tax liability? What did you have to pay in taxes? Now, I'm not saying, and then again, here's the answer I get a lot of times. Well, I didn't have to pay anything. I got a tax refund. Well, no, dude, you had to pay. You got a refund because you overpaid. You let the government use your money for a year for free. So we don't want to do that. So you should have to pay every year in taxes if you're really using your money efficiently and effectively. So let's just say that number is I got to pay $10,000 a year to taxes. Now that could be state taxes, federal taxes, local taxes. It could even be property taxes. Regardless, that money is going to be gone. It's going to leave your family forever, right? So is it a good idea to maybe set something up to where you're able to start utilizing a policy to pay for those taxes that you have to pay for anyway? Let's be able to utilize a policy where we're able to assist with paying all of those taxes. So what is that amount? Is it $10,000 a year, $20,000 a year? I'm not saying it's the right number.
Yeah,
but
no,
it's something to think about. And
what I love about you, even your answer around like how old is your age and times that by 10, and that's kind of the minimum monthly. What I love about that is that's something that is easy to understand.
Easy.
What I love about the tax examples, that's something easy to understand. I'm gonna start drilling you with questions because we actually looked at our YouTube podcast that we did, and there's a lot of questions, and so I'm going to read a couple to you. Okay, and I'm also I think we can go rapid fire here. So sure. Someone said, was he debt free or did he just transfer all that debt to his whole life policy in 3 years? And it's just going back to your story around how you mentioned early on you almost didn't put any extra money towards your debt. You learned about infinite banking, you got really fired up, you paid off your debt in 3 years using the infinite banking, and some people are saying, well, you just transferred your debt. How would you answer that?
Yeah, no, good question. And again, right? So like if I'll let you watch my full 90-minute presentation, I have a thing on there called the Money Multiplier Map, and I show an example of a guy that had $470,000 of debt, and he had the debt anyway. Before he showed up at our door, he had the debt. And he said, I'm going to put $20,000 a year of outside money towards this debt. Well, it ended up where he and again, okay, that 470 grand, Caleb, it was going to take him 18 years to pay it off. But because he ran the money through the policy, his outside money, $20,000 a year, he put it in the policy first. He paid off all the debt in 61 months, and he did it with a $160,000 outside injection. So the thing he did is he started this policy for $20,000 a year in annual premium. He still had all the debt. He still owed the $470, but he said, I'm going to pay myself first. I'm going to put 20 into the policy. He could have taken the 20 and went right to the debt with it, but instead he put 20 into the policy, and he could only use like 12 of the 20 the first year, 11 or 12. I forget what the number is on my presentation. Just call it 12. He put in 20 and was able to use 12. But he still was paying off all those. He still had the monthly nut on all the debts, didn't he? So as he was able, so the thing he did is on that example, and what most people do, they'll take the debts from lowest debt to highest debt, not interest rate. Don't think about interest rate. It doesn't matter what the interest rate is. Take it from the lowest amount to the highest amount. So if he was able to have a cash value of $12,000, and he owed this credit card $2,000, this credit card $4,000, this credit card $3,000, he can pay all of those off now, can't he? He can pay all of those off with his $12,000 policy loan, and then continue to pay himself back the same amount of money that he was sending to those 3 credit cards that he just paid off. So by doing that, is he working harder, changing his cash flow, taking any additional risk, or losing control? No, it just transfers the money. So then at the end of all this, let's fast forward to the end of the 61 months, and he's got all the debt paid off. Well, then people say, okay, well, you got it all paid off, but you still owe the policy loan. Well, sure, that's fine. Yes, you do. You still owe the loan amount to the policy. Now, do you have to pay the policy loan back on a certain timetable? Are they knocking on your door saying, hey, Caleb, when are you going to pay your policy loan back? No, because it's your debt. You control when you want to pay it, if you want to pay it. Eventually it'll get paid. Even if you die, it'll get paid because the death benefit pays off any outstanding loans. So at the end of the 61 months, what you would do is all the money that you were paying out to those 12 third-party creditors, you now just use that money to pay down the policy loan.
Right. It's like Dave Ramsey, what he teaches. You're just using life insurance, and he's using a bank account.
Yeah, but when you use life insurance, you have so many features and benefits. A bank account gives you nothing. Right?
A bank account gives you the ability to pay off your debt faster. It takes longer with life insurance, but you're right. Insurance gives you the death benefit and lots of other benefits. And one of the things that you even mentioned is, I believe on our interview, you talked about you had $30 million worth of death benefit and growing, and how you talk about that being the legacy value. And I don't know about you, Brent, but early on, I could care less about the death benefit. And now, like, the death benefit is what I care most about when it comes to planning.
Well, my kids really care about it.
Yeah. I mean, but yeah, it's...
No, you're absolutely right. So as we sit here and speak, I got $34 million of death benefit right now, as of about 3 or 4 months ago when I looked at it. Because about every quarter, at least every 6 months, I kind of analyze exactly where I'm at with my policies. And let me just tell you, this is amazing. This is why I love this. The numbers are always bigger than I think they're going to be. They're always bigger. They're always bigger. I don't expect the growth to be that much, but they're always bigger when I throw everything into the mix, which is a really good thing. But you are right. I didn't ever used to harp on the death benefit because we're solving a financial need. And as long as I solve your need for cash and finances, you'll have more death benefit than you can imagine. So I'm still of that mindset of doing that. But yes, your policies do grow in death benefit. Now, I would argue with you a little bit on I could take the cash and pay off the debt, but it depends on how long, Caleb, because as you know, as the policies get older, I could put in $1 into a policy and use $1.50.
Yeah.
So if I'm a real estate investor and so I got the real estate guy sitting right here next to me, and we're going to say, okay, let's put $100,000 into this real estate deal. Well, he's going to be able to use more money for his deal in the first 3, maybe 4 years. But when I get to 5 and beyond, and now when I put in 100, when he puts in 100, I can put in, say, 110, for example, in year 5. He can only put in 100, and he can never catch me. You know why he can never catch me? Because he can never catch up to my original policy that I started.
Totally. So, yes, and over time, this is why internal rate of return is important. Over time,
this is not a sprint. That's what clients have to know. It's not a sprint. It's a marathon. We cannot think short term. There's a book by Rick Warren called A Purpose-Driven Life. Life is like a marathon, right? I'm forgetting his quote now. It's not where you. It's not about where you start. It's about where you finish.
Right. I think that's great. And what I was saying is our policies, internal rate of return, the actual growth of the policy is going to be anywhere from 3.5% to 5% in our policies.
Yeah,
and
with
so
the dividend. And guys, listen. So the insurance companies have paid dividends for well over 125 years. That is, I mean, look, guys, 1900. You know how much shit we went through in the financial world since 1900? Recessions, the Great Depression. The insurance companies never failed to pay a dividend. They never paid a dividend. People ask me that all the time, and I tend to piss off people. I just do. Sometimes it happens. But they ask me about rate of return. It doesn't matter about rate of return as long as you're keeping the money in the family and you're able to recycle and recapture. If I go buy a car and use the money for my policy and I have a process, a system, and a concept to get all the money back and have the car, what rate of return is that? Is that all of it? What number do you want to put to that? Nelson Nash talks about it on page 68 or 69 of his book, Becoming Your Own Banker. And if you don't have this book, Becoming Your Own Banker, you better add it to your wealth building library by Nelson Nash. He talks about that. And I talk about it in the book that I wrote called Mapping Out the Millionaire Mystery. People talk about average rate of returns. Your financial analyst, your guy at Edward Jones and Charles Schwab, they talk to you about average rate of return. average rate of return does not matter. It only matters where you're at when you get in and where you're at when you get out. Your actual rate of return is all that matters.
Right. And so the actual rate of return is going to be anywhere from 3.5 to 4.5 to 5%. And so obviously your example of the checking account or savings account, it's, the average actual rate of return of a savings account long term, like you got to remember the years that it paid zero essentially, was around 2 to 2.5%. So over 30 years, having your money store in something that has twice the growing power than a savings account is objectively better. But then the savings account doesn't have a death benefit. You get a death benefit with life insurance. The savings account doesn't have creditor protection. You get the creditor protection. The savings account, you have to pay ordinary income tax on your interest. The life insurance is deferred if kept up and gives you access to that money tax-free if you use loans, and gets passed on income tax-free. And so all those factors matter. And when it comes to debt, there is an argument to be made to be getting term insurance that's convertible, paying off that debt with cash, and then taking that money that back into the policy. And that could be there could be an end-all debate. I think math would be on the side of term insurance, pay off that money, put it in, but that doesn't necessarily mean human behavior. And human behavior matters way more than numbers, because numbers, it's like why is everyone broke? It's not a math problem, it's a mindset, it's a heart problem. And so I think that's the aspect. I know due to time I'm gonna fly through some things. I love how fired up you're getting, Brent. This is so much fun for me.
Yeah, because I got a lot of comments on that, but I know if I comment.
Okay, go for it. I'd rather you address what
right. So again, I would argue if it's better to do the term and pay off the debt and do that. And again, that's what Dave Ramsey talks about. Buy term and invest the rest. Well, the problem is people aren't investing the rest. It's human behavior is exactly what you said. People, and again, guys, this is why I love this book so much. And I go back to it over and over and over again, especially once a year when I do a big event. I make sure I read this book because I realize I've forgotten more than I remember when I read that. But it's kind of like what Nelson says, once you experience a luxury, it now becomes a necessity, right? Now my wife has gotten used to riding in first class, and I can't get her in the back of the airplane anymore. It's because the luxury is now becomes a necessity. So we do that with a lot of things, and it's hard to overcome those human behaviors. Now, with that being said, I used to not be, but I'm a big fan now of convertible term insurance. Now, let me tell you, the thing that got me is because I am no longer insurable. Right now, I am not insurable. I hope it doesn't always stay that way, but I'm not insurable. And I sure wish I would have taken out a hell of a lot more life insurance on myself, even though I'm thinking, well, I don't want to overextend myself and pay bigger premiums and things like that. But if I would have converted, if I would have bought a convertible term policy of what my human life value was worth at the time, I can now convert all or part of it within the next amount of time. So I am a I'm a big supporter of telling people, and especially if people aren't sure about the concept and they don't know if they want to do it, then I'm saying, okay, well, buy a convertible term policy. Because then if you want to convert some or most or all or none down the road, you can. And if you hate paying for life insurance altogether, you can just quit it. You can just quit.
So, Brent, I didn't share with you my notes. You just totally went into my next question I was going to ask you. And it's this. It's a human life value versus starting a small whole life policy. Early Caleb would have started the whole life policy. Now Caleb would say, let's at least give them the option to decline, maximizing their human life value before they start whole life, because of everything that you just said around. I mean, I just got more term insurance approved today on my life than most people will ever have 10x on there. And I don't say that to brag. I just say, I'm practicing what I preach, and we have whole life insurance policies, but we're also, my wife and I also, when I looked at my situation, I'm like, I'm being a hypocrite. I need more life insurance. And I just got approved today, believe it or not, on a lot more convertible term life insurance. And yes, is that kind of painful to look at thousands of dollars going out the door, sure, but it's covering the value, my economic value of my life, and it's literally giving me a guaranteed place to convert no matter what happens health-wise. Now, when you talk about if someone comes to you and you take their age, times it by 10, my question to you is, do you give them the option, or do you recommend that they buy term insurance for their human life value of their life before that? Or how do you guys, what's your framework of actually protecting people first and foremost versus starting small policies?
Yeah. So I do now more than I ever did before. Before, I used to never do that. I can't speak for everybody on my team, but the one thing we've had in our team meetings, we have a monthly, group team meeting the second Tuesday of every month. And, the thing we talk about, and the thing I've really just like harped on for the last several of these meetings, is I'm like, guys, look at me. I'm not insurable. And there's going to be clients that come and say, well, I just can't do 10 times my age on a monthly premium. I can't make it work, Okay, well, buy convertible term. Even if you don't buy it from us at the Money Multiplier, go find somebody, go to Caleb or Russ, whoever, get convertible term that you can convert down the road if you want to, and now start getting around the campfire, drinking the Kool-Aid, and learn the power of the infinite banking concept and how it works. And when you do, you're like, oh my gosh, I'm going to convert some of that the whole life. I'm going to start using the money for the stuff I'm buying in life anyway. So yes, now...
And I will also say this, Brent, you can speak for me here. Your mindset changes completely when you have $34 million of death benefit on your life. Like the way you're just, it's an automatic elevator in how you're thinking, because it's like, no matter what happens, and you're wildly successful, but no matter what happens, your life has economic value tied to it. And what a lot of people are doing is like, we insure our homes, we insure our cars, we insure a lot of things that objectively speaking are getting less valuable. I know homes are growing in value. That's just supply and demand. They're getting less valuable as it ages. And so the idea is our life is our greatest asset, and you can't even compare it to a second one. Like your ability to, your economic engine to create value and provide value to others is massive, and yet it's so underinsured and undervalued. And I can speak from personal experience because I've been the biggest hypocrite, because I've had a lot more life insurance than most people would even dream, and yet when I look at my situation, I'm like, I'm not practicing what we preach. And so I'm glad that you mentioned that. You mind a few more questions before we wrap up?
Yeah, no, that's good. But I just want to add to that, the thing about life insurance, it's the only insurance that you will ever buy that is guaranteed to pay out.
Yeah,
life insurance. It's the only thing, right? The car insurance, right? Like, are you guaranteed to get in a wreck? Are you guaranteed to have your house catch on fire? No, none of that. All that other insurance, your business insurance, are you guaranteed someone's going to break in and steal all your business equipment? Life insurance is the only insurance that is guaranteed to pay out, because everybody within the sound of my voice is guaranteed to pass, die, or graduate. Whatever word you like to use, it's not an if, it's a when. So why would you value that at the least? And then on top of that, if you even care about your children and your grandchildren even a little bit, right? So don't you want to pass on a legacy to them? I am mad at myself that I did not buy convertible term insurance on myself. I didn't. I've been uninsurable now for about 3 years, and I don't have it, and I can't go get it. I can't get it right now, Caleb, and I'm mad that I can't get it.
Brent, we're going to chop this up, and this is going to be the video for convertibleterm.com, because I actually bought convertibleterm.com a few years ago, because I'm like, this is the best thing in the world. And we're just going to chop up your video of literally, that's the greatest commercial of convertible term all time.
Good. So just remember, we're to send 20% of the commissions to, okay?
I love it. Question, we'll make this the last question. We'll have you back on for sure. You're a great friend, and I just appreciate how passionate you get. Like, I love how fired up you get. Hannah has the same, she gets the same way, and she gets it from her dad. Cars. This is something that, Chris Noggles talk about, Mr. Burrs talk about. Mr. Burr made a video on how he made all this money buying a car, and I did a reaction to it, and actually he came out to our house and we talked about it, and I was like, he said in one, my policy is being super efficient, my car lost value, but I made money buying the car, and he mixed what's happening in the policy and in the external activity together. And my whole deal is like, let's separate them. Your policy is going to grow regardless. It's going to be efficient regardless. And like that's great. Like that's amazing. That's a foundational asset. The fact that you got the car, that we could argue that that was maybe the most efficient way to buy that car, but I don't love combining what's already happening inside the policy and your external activity, because then you could easily say, well, I borrowed at 5, I only earned 2%, but I'm actually ahead because of my policy. And I would just say you would be more ahead if you didn't borrow at 5 to get 2, number one. Like you'd be more ahead. And then number 2 is I find that a lot of times people are like maybe building up cash value and then paying things off like their home or their car when they potentially could get a bank loan, and they're losing liquidity to then say yes to that. So ironically, I find that it actually contradicts Nelson's premise of the golden rule and building liquidity and having control. And I find that building up money into a life insurance policy to pay for cars could work if you have a ton of cash value. And that, at the end of the day, Devin pretty much said, he agreed with me at the end and just said, the reason I do it is I just have too much money. And I'm like, okay, that's great. And, you know, from an efficiency standpoint, I wanted to hear him out. I wanted to get your thoughts on this because I know that you use most of your policies for loans that you make money on, and you're looking at it from an asset-based activity. What is your thoughts as cars? And like, what if someone was to come to you and they're saying, hey, I have cash value, I can buy it with a car. When would you ever tell them to not use their policy to buy a car?
Yeah, no, absolutely right. Yeah, there's a lot to unpack there. And again, right, so like on that presentation that I have a car example of a person buying a $25,000 car every 5 years, and they're buying it through their policy. So they're not going to a conventional bank. All they're doing is they're using the money in their policy to buy the car, and they're paying themselves back with interest just like they would pay the bank back, right? So they're doing everything the same, but they're doing it through the policy instead of the conventional bank. Now, the one thing Nelson Nash, he would roll over in his grave if he knew that I was telling everybody to go out and borrow from banks, because he would say, now we're part of the problem. We're part of the problem. But I agree. I believe that you should go out and get money from the banks if it makes sense to do so. I'm buying a property right now up in Gatlinburg, Tennessee. I'm under contract up in the Smoky Mountains as an Airbnb rental. And it's not my first choice of property, but why am I buying this particular property? Because I can assume the mortgage. I can assume a 3.2% 30-year mortgage. So, hell yeah, I want to use that bank's money to create the cash flow and stuff, and I don't have to dip into my policy money, even though I could. I don't have to. I'm going to use the bank's money because that keeps my money available to do other stuff. So I bought a truck a few years ago out in Idaho, a Ford F-150, 0% for 5 years. Absolutely. Give me the deal. I asked him, I said, if I pay cash or if I do the 0% for 5 years, what deal do I get on the truck? It was actually a better deal to do their 0% than it was a cash. I don't get it.
Yeah.
Now, it didn't used to be years ago that way.
Yes.
It wasn't many years ago.
Because if they gave you a cash discount, you would have to factor that into the actual interest rate. In a lot of cases, those who have the gold make the rules, and you actually get a way better deal.
Yeah, but now they don't do that with cars for some reason. They actually want you to take their 0% deal and through like Ford Motor Credit. Okay, I'll do it. I don't really get it or understand it, nor do I need to understand it all. Right? The one thing I'm smart enough to know is I don't have to know the solution and how it was arrived at every problem just to go and do it.
And Brent, it almost makes it sound like you agree with me from the standpoint of like using cars is a good example because it can motivate people to save, and that, which is great. And I actually don't have a problem with that. But when it comes down to actually should you use it or not, if you're someone that doesn't have opportunities or doesn't have the mindset for opportunities, it might be a really good motivator to say, hey, my savings for the future is also helping me buy the dream car. Great. But if you're an entrepreneur or if you're looking for opportunities and all, if a bank will give you loans on houses and cars, but not on startup ventures or all, it logically would say, I would actually pay a premium. I'd actually pay a premium to take someone else's money and leave my dry powder and cash value able to look for opportunities. And here's the best part. If the interest rate is getting a little too intense, I can always have my money and pay it off. So I'm never losing control by taking another loan. So I just wanted to get your sense on that, because I know that.
Yeah. So the big reason to stay away from banks is if a person is not disciplined, and they can get in trouble. Because the problem with, even though you get a low interest rate at a bank, if you don't make that monthly payment, they will foreclose on your ass. They're not lying when they say they'll come and pick up your stuff. If you took the money from your policy, all right, like let's say Caleb was going to go buy a car and borrow the money from Caleb's policy, Caleb is not going to foreclose on Caleb. You know, if you decide to skip payments or not make payments, nobody's coming to get your car. Yep. So I always say that if you're disciplined with money, then absolutely use the bank's money. But I will tell you, I have clients that are very disciplined with money, and I have clients, they think just because they have checks left, there's still money in the bank. Right? Yep. So two totally different spectrums. But no, I'm a big believer of using other people's money, because it frees up opportunity for you. And let me tell you, the more money you have, the more opportunities that you'll run into. They'll just show up. They show up.
You're a walking billboard of that. Over dinner, hearing the stories and the doors that have been open because people know, it's unbelievable. Brent, I got to go. I love talking to you. You willing to come on again to jam?
Part three, man.
Let's do part 3. In the comments, please let us know the topics that you want us to talk about. Brent, thank you. We'll also include anything that you want in the description to help what you're up to. And I'm very late for my next meeting, but it was worth it. So thank you. Be well and take care.
No, I love it, man. Let's keep doing it.